Good afternoon, everybody. On behalf of our entire team, I'd like to welcome you to today's presentation on 2020 year-end tax planning. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh. We do have quite a bit of information to go over today, so we're going to jump right in. If you've been a regular guest of our firm's webinars, welcome back. And if you're joining us for the first time, we would also like to welcome you and thank you for spending the next hour with us. You can find recordings and resources from any of our previous webinars, including those on PPP and other important issues on our website, which you see here on the screen. And it's obviously no secret this year has been uniquely challenging. Today, of course, we're here to talk tax strategy, and as you might have guessed, your tax planning might also look a little different in 2020. So that's all right. We've got a very knowledgeable group here with us today leading our discussion, shareholders Glenn Scharf, Beth Varhalla, and Suzanne Cox, as well as Brett Snyder, one of Saltmarsh's own estate and trust planning advisors and a manager in our firm's tax department. They'll be breaking down key considerations to keep in mind when planning for your family and business this year, and we trust you'll leave today with a little bit more clarity. But before we get started, just a few housekeeping items I'd like to run through. While I do that, I have a quick poll I'm going to throw out for our audience. So let's get that up real quick. What I'd like to know, have you started your own year-end tax planning yet? Give everyone just a minute. Let's hear what you're looking like right now. While we give everyone just a second to complete that poll, everyone on the line has been muted. If you have questions throughout, feel free to share them with me using the Q&A feature. If we have time toward the end of our presentation, we'll address a few of your questions together live. Of course, you're always invited to contact our team for additional guidance or questions following today's webinar, and we'll also have contact information for each of our speakers available in the slides. Our presentation is being recorded. You'll receive the recording and a copy of the slides and a follow-up email from us tomorrow, along with a survey to complete. Tell us what you've been thinking about these webinars. Did you enjoy it? What other topics would you like us to present on? So with that, I'm going to take a look here. It looks like we've got some responses. I'm going to share that. So most are on it, but we still have a few who have not started their planning yet. That's all right. You're at a good spot here with us today. I think you should be positioned pretty nicely to pick that up when you leave today. So hopefully, if you are looking for someone to help you with your tax planning, we've got a few folks you might get to know here today, and if there's someone else you'd like to speak with, let us know, and we'd be happy to put you in touch with them. And with that, I'm going to kick things over to Suzanne Cox to get us started. Suzanne?
Hey, good morning, guys. Welcome back to one of our seminars. I know it's not all focused on PPP, but we will try to make it as interesting as possible for you. I saw some repeat names on the list, so good to see you guys. Welcome back. I know a lot of people are here because they want to know about PPP. And as you can see from our agenda, it is at the bottom. So we need you guys to hang on for the first couple sections in order to get to that PPP area, because we know that that is the most exciting. But we do have some really good topics for you guys today, and some really good information from our in-house tax people and one of our attorneys on staff as well. So we're looking forward to this. What we're going to cover today is some opportunities for you. How can you minimize taxes in this crazy year? We're going to touch on some changes with estate planning. We know this is another hot topic. We're going to talk about the Biden tax proposal versus current tax law, and give you some of our thoughts on how that's going to affect you, in the upcoming years. And then we're going to hit the hottest topic of the day, which is PPP forgiveness money going to be taxable or not? So I am going to move this right over to Glenn, and we are going to talk about minimizing opportunities specifically for individuals. And you'll notice today that our theme is another fun one. Hopefully you'll enjoy that. And Glenn, I'm going to pass it over to you.
All right, thanks, Suzanne. Yeah, I remember, speaking of our theme, I remember in 1987 when The Simpsons first came out. And the reason I remember that is because I was in college and we all had to go to a bar in order to watch it because it was banned from a lot of the cable stations. And so it's amazing. You'll see throughout this presentation how well they have integrated into mainstream society on the things that we have on this webinar. I would have never expected to find so much, but it's quite amazing. So the first thing that we really want to talk about in tax strategy is one size does not fit all. And it's really, very customer-based, very client-specific, especially this year. We have some traditional strategies that are kind of upside down this year. So we want to reverse some of these things, especially when we've got COVID, that we've had this year. And then coupled with that, we've got a new change in, a presidency in legislature pending, in January. And so a lot of it is, okay, and we'll see what the Biden plan is later on in the presentation, but that upside down strategy is, okay, we're gonna have potentially, we don't know, higher taxes next year. And so we've encouraged a lot of clients to really kind of move their income into this year and delay expenses into next year. And so it's kind of a reverse strategy that we have going on. Let's go to the next slide.
Yeah, just real quick to add here, back to the title of this, one size does not fit all. So if you haven't had a discussion with your tax provider yet, please do so, because things don't look the same for every person. So just keep that in mind. It's December. It's plenty of time to get on board and get with your CPA.
Yeah, and I'll mention that also that 30-something% of y'all said no, you hadn't started planning. Well, if most of the CPAs are like our firm across the panhandle, we've had hurricane extensions, we've had COVID, we've had all these delays, and so we're much due for vacations. And so, these last 2 weeks of the year might be a little tough, so don't wait until the last minute. I would encourage you to really start this process as soon as possible. So let's talk about, from an individual perspective, retirement relief. And this is one, there's a lot of changes this year, especially from COVID and the CARES Act and things like that have really taken place. And this is one of the big ones. So required minimum distributions out of your IRA, that happens usually when you turn 70 and a half. If you were 70 and a half and you'd already been taking required minimum distributions out of your IRA, you're still required to do that. But they did change the law in making it to 72 now. So now the starting age is 72 instead of 70 and a half. So it's really important that we understand that this year in 2020, you don't have to make one. So you can delay your required minimum distribution, not even delay, defer. Now, granted, if you do that, certainly your future payments will be higher, but you don't have to take one this year. If you already have, you did have a window of time to redeposit that. That window, I believe, is expired already, but if you haven't taken your RMD, like a lot of people will take theirs right at the end of the year, you don't need to. So that's really one big thing that can really change the gamut of your tax situation. Then on the opposite side, there are COVID-19 related distributions. So really, these are distributions that have certain qualifications from it. So if you're sick from COVID, if you've been directly affected by COVID, you've lost your job, those type of things. There's anything financially that has affected you by COVID, you're going to qualify for these special distributions. So you don't have to be 59 and a half, you don't have to be 70 and a half, you can take these no matter what age you are. Now, the important thing to know is that there's no early distribution penalty. So typically when you have someone under 59 and a half take out of an IRA, there's a 10% penalty. Well, that's been waived for these distributions. So, and then the big thing is that you can spread out the taxability of it over 3 years. So for example, like it says here on the slide, the maximum is 100,000. So let's take out 100, let's take out 100, well, let's say 90,000, I'll make the math easy. If I take out 90,000 out of my IRA this year, I am not 59 and a half. Then I'll have no 10% penalty, but I'll only have to include $30,000 in my taxable income this year. then $30,000 next year in 2021, and then $30,000 the following year in 2022. Now, the big question is when will you have to pay that? Typically, you've got to do a little planning here if you do these things. Typically, you can have withholding taken out. Well, taking out withholding out of this distribution is a little kind of defeats the purpose of paying it over 3 years, because withholding is taking that tax and putting it into the system. So you're going to have to save for that tax over the 3 years. So, when you get your 90,000, you may want to just stock, some aside, based on whatever your tax rate is. Now, the big thing with this is that you can repay the distribution to avoid your tax. So within that 3-year period, if I repaid the 90,000, then I don't have to pay any tax, so it's kind of a loan. Now, you do have to file and pay the taxes as you go. So if you pay it back in the 3rd year, you will have to amend your returns and recover that tax. So finally, on the Roth IRA conversions, this is another that we're seeing very popular this year because of people looking at, okay, what is my tax rate now today? What is my tax rate going to be next year or in the following years? And really converting those traditional IRAs into Roth IRAs. Now, this is not, for people who are already taking RMDs, things like that. These are, if you're younger, if you're 40 or 50, then you might want to consider this because you've got time to make up the tax that you're going to pay on the conversion. Roth IRAs are not subject to these RMDs. So when you turn 70 and a half, there's nothing that you'll have to take out of these RMDs. So whatever is in your regular IRAs, those will be reduced. So you can kind of tax planning later in your retirement years. Typically, obviously you want that your income to be as high as possible without paying as much tax, because you're kind of on a lot of people are on a fixed income in retirement. I know that was a lot. Anybody have any interjections before we go on to the next slide? No? All right. So let's talk about retirement relief. So what can we do? We talked about, okay, you don't have to take your RMD. What else can you do to really, reduce your burden for your retirement? Now, it's been around for a while, these qualified charitable contributions. And basically what that is, it's limited to 100,000. It is a distribution out of your IRA directly to a charity. So it is, you call up your broker and you say, hey, I want to donate to the United Way or to whatever charity, you want a charity, your church, it doesn't matter. And basically they write the check directly to the charity out of your IRA. That satisfies your RMD requirement. So if if you have to take $50,000 as your RMD, you can designate $50,000 to go to charity, and that will not be income to you. Now, you don't get a charitable contribution either. So if you're using that to try and get itemized deductions or whatever, that doesn't count towards that. But this is a much better way to do this because you're getting a dollar for dollar off of your taxable income, as opposed to, you already get the standard deduction of, $24,000 if you're married. It's 24 and some change now, but so you want to be able to make sure that you're utilizing this money for that charitable purposes. And then if you don't itemize, then that's okay. You're still going to get that, $25,000 of a deduction. There's no age restrictions for these IRA contributions this year. It was 70 and a half, but now they've taken away that restriction. So we're able to really use some of these funds to fund some charitable giving, as opposed to taking it out of your taxable income already. Okay. Next is net operating losses. So, we moved we moved the slides around. Sorry. Charitable contributions. So they moved some of the limitations for charitable contributions. So typically you are only allowed to take charitable contributions, cash contributions, up to 60% of your income. That has been suspended for COVID. I don't know anyone that's doing this, but you can donate up to 100% of your gross income if you really wanted to wipe out all of your taxable income in 2020. So it's a good planning technique for those that once again have income, don't need it, have, you know, and want to do some charitable giving this year. Really good technique to do that.
Yeah.
The other thing about, yeah.
Oh, I was just going to say, just a reminder to people, we did check on this. That does, the key word here is cash. So don't, you know, donate all your old purses and shoes and think that's going to count. So that is the key word here to remember, is that is cash. Right.
And Suzanne had to look that up because she had so many purses and shoes that she wanted to give away that
exactly.
You had to figure that out.
In 2020.
Right. So the other thing is, you know, consider donating capital gain assets. So the advantage of this is, you know, so let's say you have a stock. Let's pick a good one, Facebook. You bought it at 20 back after their IPO, and now it's 200 and something. So you've got a huge capital gain in there. So let's say, you know, you bought it for $2,000 and now it's worth $30,000, and you want to donate $30,000 to a charity anyway. So you can take that stock and donate it to the charity. Now, this is the actual stock. Don't sell the stock and then donate the money. You're donating the stock to the charity so that then they can sell it and then use the money for what they want. You get the tax deduction of the full amount, so, you know, the $30,000, and you don't have to pay the tax on the gain. So it's a double whammy on a win. And when you get a double win from the IRS, you should take it. Now, this is not new. You can always do this. So this is a way, you know, especially with that 100% of taxable income, you know, to really get a big benefit in not having to pay a gain and getting, you know, potentially a lot of your income wiped out. Okay, so for those that don't have itemized their deductions, there's a new deduction this year. It's a $300 deduction for charity. It is cash only, and that is actually what we call an above the line deduction. So it is basically reducing your income directly without going through your itemized deductions. So everybody can take this, no matter whether you're itemizing or not, which is a great little $300 benefit. Now we go to net operating losses. So net operating losses, the CARES Act really provided some favorable opportunities in this arena. Back when they changed the law originally, they took away, you know, the net operating loss carryback. They really kind of restricted how much you could use of your NOLs. And so now they've really kind of beefed this back up in being able to utilize NOL. So any net operating loss, whether it's on your personal return or on your business return, you get a that are generated in 2018, 19, or 20. So we can look at 2018, these losses that we had, and you can carry back them 5 years now. So that is a really, really big opportunity to look at, okay, where are my losses now? And can I carry it back to 2013, 14, 15, where maybe I had some higher tax years versus carrying it forward where I may have some lower tax rate years. So really there's a good opportunity to plan if you are having a loss, especially this year, in where you want to go with that. I mean, we all know on the corporate side that a C Corp's earnings went, taxable rate went from 35 to 21. So this year, if you're paying 21%, and you have a loss and you carry it forward, you're only going to have 21% to carry it forward to, versus going back 35%. So it's really saving a lot of a 14% spread in the corporate area. And the same can be true, depending on your situation for an individual. All right, I think it's the last slide in this area, Suzanne. Casualty losses. Okay, now Kent Brockman over here. We've all been through this that Kent's going through. We have been through that this year with Hurricane Sally. If you don't live in the Gulf Coast and you've had other federally declared disaster areas, I know we've had people in California on these webinars before, so if you've gone through the fires, if you've gone through a tornado area, and anything that's been declared a federally declared disaster area, you will qualify for a casualty loss. Now, qualifying for a casualty loss and actually getting a loss are two different things. There's always a catch here, right? So really the loss, you have to understand what the loss is. The loss, if the loss is going to be repaired by all of your insurance, then you're probably not going to have a loss. The only loss that you could possibly have is going to be your deductible. So for example, if it's hurricanes, hurricane deductibles tend to be 2% of the value, so they can be very high, depending on the value of your home. I mean, a hurricane deductible can be 20, 30, 40%, $40,000. Well, that's a lot. So that's kind of a hurdle that you have to get over, is what really is my loss? Once again, if you're covered by insurance, you've got to timely file a claim. So you can't just say, oh, well, I don't want to file a claim. I don't want my insurance to go up. I'm just going to take a loss. Well, you don't get it. Okay, you have to file that claim first. Now, the loss is deductible in the year that it's incurred. So we had Hurricane Sally this year. We can deduct the loss this year. However, this year we've had a lot of other things happen. And so, we've got, potentially lower income this year versus 2019. You can elect to deduct the loss in the preceding tax year, so in 2019. So that could be a real benefit to look at if you've sustained a significant loss, like an uninsured loss or something like that, that you really, really have the opportunity to carry it back to a higher tax year.
Now, Glenn, would you have to amend your prior year?
Yes, so it would be through, well, unless you live in our area here and have not filed your tax return. Tax returns here on the Gulf Coast have been extended to January 15th. So unless you haven't filed your tax return, and those few that have not, you would have to amend your return.
Got it. So we did have a question on the previous slide regarding charitable deductions. It
Sure.
says, if I have received a beneficiary IRA this year, I have a RMD requirement going forward. Can I give it to charity?
That's a really good question that
Way to put them on the spot,
know.
Jerry. You like these, keep them coming.
Right. So that one we'll have to follow up with you. That's a really good question. Inherited IRAs are treated differently than other IRAs, especially if you received it this year, because you are required. They used to have this lifetime span of an RMD when you have an inherited IRA. And Brett, you probably have maybe some insight on this as well. He works in this estate area a little bit more than I do. But the inherited IRAs have now changed, and you must, a non-spouse must take an inherited IRA over 10 years. So there's no election to span it out over your lifetime anymore. They want you to take it out over 10 years. So I don't know if you can use that once again from an inherited IRA. Brett, do you have anything? Do you know?
I don't know off the top of my head for an inherited IRA, but you're right about the changes to the 10-year rule, where from a lifetime measuring stick to a 10-year requirement to distribute the inherited IRA for a non-spousal inherited IRA.
Okay. Anything else, Suzanne?
We can move right along here. So for those of you that have been in our PPP webinars, you know that we have a few resident attorneys on staff, and we love to tease them mercilessly because when they do PowerPoints, they use a lot of words and a lot of big words. So we have tried to scrub this for you, but if you run across a word that you have no idea what that means, please focus. Don't go over to the Google and start trying to find out what that word means. So we did try to scrub it for you though, so I hope we've achieved that. So Brett is one of our extremely talented attorneys on staff, and he is going to be talking to us about estate planning. So Brett, I will pass it over to you.
Thank you, Suzanne, for that very warm welcome. So we're going to talk a little bit about estate planning this morning. There's a lot of stuff, a lot of information here. So we're going to try to just hit the highlights, starting with a look at 2021. For 2021, the lifetime exemption, or the amount that you can pass to your heirs free of any sort of transfer tax, which would be your estate tax, your gift tax. That amount is going to be up to $11.7 million for individuals, or $23.4 million for married couples. This is the highest the exemption has been in history. And we can expect this exemption to continue rising, assuming that no changes are made to the estate tax laws until the expiration of the Tax Cuts and Jobs Act, which occurs at the end of 2025. At that point, we expect the exemption to reset to their pre-2018 levels, which would be $5 million for individuals and $10 million for married couples. Also for 2021, the annual gift tax exemption, being the amount that you can transfer annually free of any sort of gift tax, is going to remain at $15,000 per recipient for individuals, or $30,000 per recipient for married couples. Looking ahead to what might be on the horizon, before we kind of dig into that and to what President-elect Biden's proposals are, we should probably do a little bit of forecasting on the likelihood of these proposals getting through Congress. And the results of the Georgia U.S. Senate runoff election will give us a better idea. If Republicans win even one of those seats, the chances of Mr. Biden's proposals being passed becomes pretty minute. Even if the Democrats take both of those seats in Georgia, they're going to have razor-thin majorities in both chambers of Congress. And the likelihood of these things passing in their proposed form probably isn't real high either. And that's because some of these proposals, as we'll see, are eliminating provisions that have a lot of strong bipartisan support and are really, really popular. So with that preamble out of the way, let's take a look at some of the proposed proposals compared to current law. Mr. Biden has proposed turning the clock back on the estate and gift tax laws to 2009 levels. This would mean that the estate tax exemption would return to $3.5 million, and a lifetime gift tax exemption would be capped at $1 million per taxpayer. This proposal is way different than what we've got right now. This proposal essentially splits your estate tax exemption and your gift tax exemption into two separate exemptions. Right now, we can transfer over $11 million either during our lifetime or at death. Mr. Biden's proposal would change that by limiting the amount of lifetime gifts a taxpayer can make tax-free to $1 million. That's going to, and then at death, they can pass along an additional $3.5 million of assets tax-free. As you can see, this change would severely limit taxpayers' ability to maximize gift tax to maximize gift planning techniques during their lifetime. The step up in basis is also another change that he's proposing to make. Currently, when you die, the basis in your assets are stepped up to their fair market value on the date of your death. This essentially eliminates all capital gains when those assets are sold. Mr. Biden has endorsed eliminating the step up in basis. However, what is unclear is if his proposal would also tax that unrealized gain, that built-in gain that's in those assets, that's value has gone up over time since you purchased them. And this is really, really important, especially if the capital gain tax rate for certain taxpayers is raised to 39.6%. Such a proposal could end up being very costly to a much, much wider range of taxpayers than the estate tax currently hits. The tax rate would also change. Mr. Biden is proposing to increase the rate to 45% from 40%. And portability is another thing that could change. We don't really know. He has not directly addressed this, but what portability is that when the first spouse dies, any of that exemption, any of that $11 million worth of exemption that they have not used gets added to the surviving spouse's exemption. Essentially, that could double the surviving spouse's exemption amount. That's where we get that $22 million per married couple when we say that. Portability is probably one of the biggest and most popular changes made to the estate tax laws in the last 10 years. And like I said, while this has not been directly addressed by the Biden administration, it would follow in line with what he said he wants to do in returning estate tax laws back to what they were like in 2009. So that's just something that we need to keep an eye on.
Yeah, and just to add, I was in a continuing education program yesterday that said that the number one reason that people do not have an estate plan or are thinking about retirement or death is because they don't want to think about death, that they think they're invincible, that they are going to live forever. And logically, we all know that's not true. I thought that was a staggering statistic that is the number one reason that people don't plan, is they don't want to think about death. So don't be one of those people. Come and talk to us or another qualified CPA about this. This is a really, really important part of your life and the end of it. So Brett is still going to keep telling us a little bit more, but I just wanted to throw that in there, that this is really important.
Yeah, my dad always told me there's only two sure things in life: death and taxes.
And we're talking about both of them today, you guys. This is all in one right here.
Learning lessons.
I believe that's called a twofer, Suzanne.
Exactly.
And we will get to why estate planning can be very important and why we should think about it, not in terms of that we don't need to do it because we're invincible or that we won't die or nothing can happen to us. And we all know that's not true, but thinking about how can I make this as easy as possible on my heirs? How can I make this process as painless and as seamless as possible for when I die? Because they'll be dealing with a lot of other issues at that time, grief and moving forward. The last thing you want to put on them is trying to untangle a messy estate plan or no estate plan, as we'll get to in a minute. But like Suzanne said, we've got some simple little estate planning tactics that we can kind of talk about right now. The first one being making annual exclusion gifts of $15,000. What remains as true today as it was in the past, and it will likely remain that way into the future, is that making annual exclusion gifts of $15,000 is the only freebie in the tax code. Meaning that if your estate is going to be taxable, for every $15,000 annual exclusion gift that you make, you're saving $6,000 in transfer taxes. Those are your estate and your gift taxes. That is $6,000 that goes into the hands of the people that you're choosing for it to go into, instead of into the government's hands. Just be mindful though of what you gift. You don't want to gift an asset with a low basis, say, IBM stock that you bought years and years and years ago for, $25 a share, and now it's worth way more than that. Because when you do that, you're gifting an asset that's got a built-in tax liability when it's ultimately liquidated by the beneficiary. With that in mind, you can also make a lump sum gift of $75,000 for individuals and $150,000 for married couples to a Section 529 education plan free of gift tax. And what happens in that instance is that lump sum gift is spread out equally over 5 calendar years. So it's essentially treated like you've made $15,000 annual exclusion gifts, but you did it all in 1 year. And also keep in mind too, that payments made that you make on behalf of someone else directly to a school or directly to a medical provider, like a hospital, are not considered a gift for gift tax purposes. That way they don't eat into your lifetime exemption, and they don't go against your $15,000 annual exclusion amount. Some other things to keep in mind when you're thinking about estate planning, what you might want to have. The first thing being a last will and testament. It sounds redundant. It sounds simple. Of course, we would have one, but you'd be surprised at how many people do not. As you know, a will contains a detailed list of instructions as to how your property should be passed and distributed upon your death. If you die without a will, you're putting your estate plan in the hands of a state statute. And look no further for the pitfalls of this than the singer Prince. When Prince died in 2016, he left an estate with an estimated value of more than $200 million, and he left no will. Currently, a Minnesota judge is distributing his estate among his 6 siblings and half-siblings. However, due to challenges, including a federal inmate claiming to be Prince's long-lost son, that distribution has been delayed. After several years, lawyers, accountants, consultants have earned millions off of Prince's estate, but the heirs still have not received much of anything. A revocable trust is something else that a lot of people ask about. A revocable trust covers what happens to the trust assets during your lifetime, what happens to them if you become mentally incapacitated, and what happens to them upon your death. One area where revocable trusts are really, really great are for those who are no longer married, who are single. That's because if a single person becomes incapacitated, the successor trustee steps in and can handle their financial matters. As financial institutions are becoming increasingly wary about accepting durable powers of attorney, we're finding that they are not nearly as weary about dealing with a successor trustee. That's just something that's a whole lot smoother and a lot easier to put into place. And a lot of financial institutions will accept one form of a power of attorney. Others will accept a different form. And so you never can find any sort of power of attorney or something like that that's just going to cover everybody. But a revocable trust can do that once the successor trustee is named. One other thing that you can kind of think about doing this year and into next year is making a large lump sum gift if you know that you're going to have a large estate, and that could be an estate that's valued over $22 million right now if you're married, or that's going to be valued over $10 million in a few years, knowing that the estate tax exemption is going to roll back. What this allows you to do right now is if you make that large gift now, be it directly to a beneficiary or to some other sort of like irrevocable trust that has been created for your heirs' benefit, is that it removes those assets from your taxable estate, regardless of what happens to the exemption in the future. Meaning that if you make a $22 million gift today, and then next year the estate tax exemption gets rolled all the way back to $5 million, you've really made out like a bandit because you've gotten rid of a lot of assets that would have been taxed at 40%. And now all of a sudden you're looking like a rose because you've got all that stuff out of your estate, and it will no longer be subject to that transfer tax at your death. The IRS has already issued some regulations saying that any gifts made under the current exemption amounts will not be quote unquote clawed back when the exemptions ultimately go down in the future, because we do know that they are going to go down. We're just not quite sure to what levels. However, to take advantage of this, you must make your gifts in excess of what the reset exemption amount will be. A good rule of thumb would be to say we have to make them in excess of at least $5 million right now. So that means that the exemption resets to $5 million on January 1st, 2026. The gifts made in excess of $5 million must be made to take advantage of this clawback prohibition. And that is our brief look at estate planning for the future.
Thank you so much, Brett. So now we're going to pass it back to Glenn to talk about some opportunities for businesses.
All right, thanks, Suzanne. I wanted to really circle back up real quick on one thing on the question that we had on the charitable distribution for a non-inherited IRA. You are allowed to do that. But I do want to caution everyone just one tiny thing. When you get your 1099 from your broker for your RMDs, they mark it as it is a normal distribution. So if you just give your 1099 to us and you don't tell us you made a qualified charitable distribution, we're going to put it in the computer and it's going to be taxed. So you have to make sure that you get those acknowledgement letters from your broker and give them to us, to make sure you don't get taxed. So, all right, let's move on to business opportunities. The number one thing that we always talk about is depreciation. So depreciation planning, we've got two big items here from how we deduct things. The 179 depreciation limit, this is up to now $1,040,000 for 2020. So if you want to buy equipment, you can deduct up to $1,040,000. Now, once your purchases start getting over $2.5 million, then that max deduction is reduced. And then also the 179 limit also has an income limitation on it. So if you bought $1 million worth of equipment, but you only had $500,000 worth of income, you're only going to be able to deduct $500,000 of that equipment, and then the other $500,000 would carry over to the next year. That's always a good technique. We used to use that a lot before bonus depreciation kind of came into play. So now bonus depreciation is 100%. So right now, anything that you buy, 100% of that item can be deducted under bonus depreciation. Also with bonus depreciation, now it includes used property. Before it was only new property. So if you bought a used car, you couldn't use bonus depreciation, or some other used piece of equipment, you could not use bonus depreciation. You would have to use 179. So now you can use bonus for pretty much anything. And so 179 has kind of become a little bit less used, but there still are strategies depending on what, the situation that you're in. So bonus depreciation also has to be, you have to elect out of it. So it's kind of mandatory unless you elect out. You have to elect out of it also on a whole class of items and not just one item. So if you bought, 30 computers and that's all you bought the whole year, you couldn't say, oh, I only want to take bonus depreciation on half of it. You can't do that. So
if you guys want to take a photo of this slide, these are most commonly asked questions right here. If you're taking notes, jot these ones down.
Right, for sure. All right, so the CARES Act gave us another opportunity on qualified improvement property. And so qualified improvement property is really improvements made to the interior of a commercial building. So if you're doing a build out for a lease, okay, that would qualify. You're putting in extra walls, you're reconfiguring your space, especially now with COVID. You used to be in an open forum, you used to have desks all next to each other. Now you're making little offices. So all these things would qualify for qualified improvement property. What used to be qualified improvement property was depreciated over 39 years. And when they made the TCJRA, the Tax Reform Act that Trump had, they forgot to reclass this qualified improvement property to 15 years. And so, because the definition for this qualified improvement property was anything classified 15 years or less. They put the definition in there, but they forgot to change it. So now we've changed it. So the CARES Act give us an opportunity to go back and deduct this 100%. So even if you place something in service in 18 or 19, now we can go and still deduct all of that, even though you were depreciating over 39 years before. So it's a real big opportunity if you've done a lot of improvements to a building to really get a current year deduction. So big items, big ticket items are there for that. Okay, so the other thing that we have is this qualified business income deduction. So this, anything but a C corporation it applies to essentially. S corps, partnerships, sole proprietorships, you get a deduction for this if you are in a non-excluded business. Okay, so there are some businesses that are excluded. For example, doctors, lawyers, accountants, you're all excluded from this. You can't take it. So it is a 20% deduction from your business income. So this is really, really big. But there are limitations to how you calculate that 20%. As you can see, it says up to 20%. I feel like a mobile phone person offering a rebate on your phone. It's up to. So anyway, so you have to consider strategies about your income in order to avoid the limitations. The limitations come around a couple of things. Payroll is one of them. So you have to make sure you have sufficient payroll in order to get the full deduction. So sometimes we run into this with maybe an S Corp with a single owner. They're the only employee and they're paying themselves a lower salary with high income. So you know, there could be a benefit to paying a higher salary and paying a little bit more payroll taxes, but saving a lot more in income tax. So you kind of have to look at that and make sure that you are having enough payroll to get that full 20% deduction. We want to make sure that we consider year-end asset purchases to increase your basis. So the other limitation is this basis in your assets. So it's a very small number. Typically, we don't see that being a hurdle. But if you're in a high number of asset business, so for example, construction, if you buy a lot of construction equipment and you've got millions and millions of dollars and you have lower income, you may want to consider bumping those up if you're accelerating that into this year in order to get that qualified business income deduction limitation raised. All right, let's go to the next slide. And I think we'll turn it back over to Suzanne. Oh, I did want to do one other thing. I'm sorry. So in looking at strategies for business, okay, there are a lot of things that we can do, and especially if you're going into new business. With COVID here, a lot of companies are looking at things differently. They're looking at how to revamp their business. I mean, we've all heard of the distilleries, now making hand sanitizer and things like that. There can be tax consequences for that. So make sure that you talk to an advisor if you're switching strategies within your business, and talk to them ahead of time so that you can kind of lay out, okay, are there any tax implications? So for example, spinning off a business, a business line of business or something like that. You want to make sure that you do that in tax-friendly ways so that you don't get hit, on accident, so to speak.
Yeah, that's a really important last point there. So yes, we are going to move this over to Beth now, and she's going to give us a little rundown of the Biden tax plan versus current plan. And this is one of our favorite memes or pictures. We, like Glenn said earlier, we were surprised at how many of these we found that were so applicable to today versus, the 90s. So Beth, take us away here.
Thanks, Suzanne. Yeah, as Brent mentioned earlier, we have a new president-elect, and Biden has pushed out numerous tax changes that he hopes to incorporate into law once he is sworn in. Again, we're waiting on the results of the Georgia runoff on January the 5th, to see what the partisan split is going to be in the Senate, and that will certainly dictate how successful Biden will be getting his tax changes through Congress. So my first slide, I've got two slides. My first slide is going to be reviewing a few things that Biden is proposing to change for individuals. So first, the top tax rate for individuals under current law, it is 37%. Biden's proposal is to bump that top tax rate up to 39.6%. And again, that's just for the top tax rate. The other tax brackets would stay the same. The second item is the capital gains rates, and I have actually received a lot of calls from clients on this. I'm sure Glenn has as well, as we're talking to our tax clients. Currently, the capital gains rates are from 0% to a maximum of 20%. Biden's proposal is to assess taxpayers with an excess of $1 million in taxable income to ordinary rates for their capital gains. So they would pay 39.6% on their capital gains, which is a huge jump, almost double the top rate currently. So that is a huge hit. Next is itemized deductions. Under current law, there is a cap on SALT, which is state and local tax. That is one of the components of your itemized deductions. Medical deductions, the SALT deductions, interest and contributions make up your itemized deductions. And that $10,000 limit on the SALT deduction really has caused a lot of taxpayers to be unable to take itemized deductions, and they're stuck taking the standard deduction. So Biden is proposing ending that SALT cap, and so allowing more than $10,000 for your state and local taxes on your itemized deductions, and certainly that would help people to be able to itemize who perhaps couldn't in the past. But he does want to restore a limitation for those taxpayers who have an excess of $400,000 in taxable income. So that might limit that at that point. In the area of employment and Social Security tax, under current law, the Social Security cap is $137,700. And what that means is on your W-2, when you've got earned income, once you reach that limit, the Social Security taxes are not taken out anymore. And that's 6.2% by the employer, 6.2% by the employee. Biden, under his plan, would leave that threshold the same, but then once you reached $400,000 in revenue, in income, you would again have to withhold those Social Security taxes and pay those out. So that's a big change as well. Retirement incentives. Currently, employees have the option to enroll in 401ks that are offered by their employer, but there are some employees who do not have that option with their employer. So Biden is proposing a 401k that other employees can enroll in that are not offered by an employer. So it's an automatic 401k for all taxpayers. Last, we've got the home buyer credit. Currently, there is no credit under current law, but Biden's proposal is a $15,000 credit for a first-time home buyer. So the credit would be refundable and would be paid upon purchase of the home, not on the tax return of the purchaser. So the last time there was a home buyer credit was in 2008 in the form of a 15-year loan with certain forgiveness provisions. Biden's credit would be permanent, no forgiveness or payback issue, and also Biden is proposing a renter's tax credit, which would be available to low-income taxpayers who spend more than 30% of their household income on rent and utilities. So that is the highlights of potential changes for individuals. My next screen is a comparison of tax law, current versus Biden for businesses. Again, the first item is the tax rate issue. Currently, the tax law or the tax rate is 21%. Biden's proposal would bump that up to 28%. And again, this would apply to C corporations who pay their own tax at the entity level. That's where this tax would come in. The QBI deduction, this is what Glenn just talked about, the 20% deduction for business owners. Biden's proposal is to phase out that deduction for those with income of, you guessed it, greater than $400,000. And that would be a significant change for a lot of taxpayers. Like-kind exchanges, currently those are allowed for real property only. Biden's proposal is to eliminate that option for real estate investors and taxpayers with income greater than $400,000. And then the last two items are tax credits. The Made in America tax credit is a new credit that Biden is proposing, and that is a 10% credit for companies creating jobs for American workers. And then in the area of community and workforce development incentives, currently there are several credits available: opportunity zones, new market tax credits, work opportunity tax credits, and then Biden is proposing a new manufacturing communities tax credit, which is to incentivize qualified investment in communities affected by mass job losses. And along with that, expanding the existing credits that are available under current law. And in a nutshell, those are the top changes that we thought would be good to share with you. And I'll push this back to Suzanne.
Uh-oh, we lost Suzanne's audio.
We were having some reverb issues earlier, so I did mute myself. I apologize. Just so everybody knows, we realize we're running a bit short on time, and we do have a lot of very good questions that we will respond individually to you, to each of your questions, because like I said, we're running a bit tight on time. So I am going to pass over to Glenn to talk about PPP, and just ease your mind. We will get back to your questions individually.
All right, what everybody's been waiting for, our favorite term, PPP. If you haven't attended any of our 8 other webinars specifically on PPP, so here's the nutshell. The biggest question right now is, what do we do with the expenses? Is it taxable? Are they not taxable? And all that good stuff. So, well, let's start first for file for forgiveness as soon as possible. Okay, there is no reason to wait. There are advantages that we are going to be able to get through, but you can't do it until you file. Okay, so first of all, there's a new form called the 3508S. This is for loans under 50,000. The documentation requirements, etc., are much less for these loans, and they're much quicker to get through the application process. So if your loan is less than 50,000, some banks are now just having those on their portal and available. So as soon as you get information from your bank, go ahead and file. There is no pending legislation for this auto forgiveness for loans less than 150,000. We've been talking about it for 8 months. I wouldn't count on it. So like I said, just go ahead and file and let's get it over with. Now, the expenses. The expenses are non-deductible. Okay, so right now, on your balance sheet, you've probably got your PPP loan, and then on your income statement, you've got all the deductions, whether it's however you want to allocate it to, to payroll, to rent, to utilities, all those different things. Okay, well, you can move that PPP loan right over to the income statement, because that's essentially where it's going to go to offset all of these deductions. It does affect, the non-deductibleness of these qualified, of these expenses do affect your R&D tax credit. They do in fact affect your qualified business income deduction that we talked about. Okay, so if your payroll for QBI, your qualified business income, is going to be a lot, probably 20% less than it was before, because you're going to have to take those out. Now, that goes to a strategy of how you want to allocate your expenses of your income and of your payroll and your other deductions. But you're talking about a very minimal effect, because remember, you got to use 60% of your PPP loan on payroll. Now, there is a House and Senate bill that would make all the expenses deductible. So that could flip-flop here. We don't know when that is going to be voted on. I mean, they're trying to vote now on just keeping the government running. So this is not on their high priority list. I can tell you most likely we're going to get this bill passed right after we need it, because that's when all the useful PPP guidances come out. So really, I mean, it's kind of difficult to say. And I had a conversation yesterday, and real quick, with a guy that was a C Corp and a personal service corp, okay? And you have to pay out all your income by year end. Well, then if you do that, if you include these, the PPP income, you have to pay out all this extra money, maybe potentially that you have because of the income, and then they come back and say, oh no, the deductions are deductible. Well, now if they had a $900,000 PPP loan, okay, now they got a $900,000 loss that they're going to have to carry forward, and it creates a mess. Okay, so really, we don't know when this is going to happen. So I would expect, if you have never filed for an extension, okay, you're going to expect to file an extension this year until that forgiveness process has been granted, and until these House and Senate bills have either been, passed or, dead. We have got to wait. And there is no truth to filing an extension and being subjected to an audit or higher percentage of audit or anything like that. So if you think that, you can throw that out the window. An extension does not affect that. So we're going to be planning on telling our clients to extend until this process is completed. That's all I got, folks. Suzanne, you want to close us out?
I will. So like I said, there were some very good questions and we will respond accordingly. I'm not sure if Jamie's going to pop back on to give us our final words here. Thank you all for attending. We really enjoy these and hope you did as well.
Yeah, absolutely. Interesting fun fact. We started the webinar with just as many people as we have now. So I think that's a win for tax. Thanks for hanging in there with us, guys. There's a lot of information. I've had some people ask if we will share the slides, which we will. You can expect those by email from us by close of business tomorrow at the absolute latest. We'll share the recording from this session as well. So thank you to our speakers. You guys are awesome. Thanks to everyone who came and joined us today. We will hope to see you soon and we hope you have a great day. Thanks.
Thanks, guys.
Bye, everyone. Thank you.